So as the year winds down, one of the things that people want to know is what's in store next year. Now, we see what's happening here in the broader economy. We are seeing interest rates are rising. I'll address that in just a minute here. But in terms of the equity assets that most people are holding in their retirement portfolios, one of the things is the standard, of course, is big U.S. stocks. A lot of people, old school, they used to think of the Dow Jones Industrial Average. Much more relevant is the S&P 500. You could even argue that the broader U.S. market in terms of the Russell 3000 is actually more relevant. But today we're going to look at the S&P 500. It is a relevant benchmark when you are considering what the biggest U.S. companies, Apple, Microsoft, United Health, Pfizer, some of the biggest names. I think Johnson & Johnson is in the top 10. Did I mention Google? That's in there. So a lot of the big names that you know about, you hear about every day that you're familiar with, but also a whole lot of other very big companies that are not as famous or not household names are in that. It's a very good index of what the big U.S. companies are doing, how they are performing. What you're looking at here on the top is a view of how earnings of these 500 biggest companies have declined recently. That's a year-to-date chart. Below that is a year-to-date chart of the performance of the S&P 500. And you see the index has been declining. 2022 has not been a great year for the S&P 500 or for global equities, really. I'll address that in a future video. As we're seeing margins being squeezed, earnings declining, that is going to have further effect upon the value of your investment. So that's something you need to know about going into 2023. Don't expect to get the same kind of return just on autopilot that you've been able to get for many years. Now let's take a look at what's happening on the fixed income side. Okay, so here's a really good comparison. And this comes from a webinar I just did not too long ago. My colleague Serge Berger came up with this data, and you see that he sourced it from BlackRock, Bloomberg, and a number of other sources. Here, very good compilation of what's going on in terms of various forms of fixed income instruments, U.S. Treasuries, 6-month T-bills, 1 to 3 year Treasuries, coming up here to investment-grade corporate bonds, emerging market bonds. So you see here, the yields in 2021, you can go across the board, that's in green, significantly lower than the yields at the end of October in 2022. And that's the most recent quarter available as of this recording, winding down December, so I don't have the fourth quarter data yet. However, you get the point, right? Interest rates have gone up sharply in 2022. And what that does, that enables you to think very, very differently about the fixed income side of your portfolio. Now, I know that's the part that a lot of people think is super boring. And frankly, we have been in a bond bear market basically since 1980. So it's been a very, very long time. And we've all kind of gotten accustomed to these lower interest rates. Now, as consumers, that's a great thing if you're getting a mortgage. But as a retirement saver, this is actually something good. You can get a better return in your investments. Always some kind of trade-off there, right? Just be aware of that. So the days of fixed income as simply being there to dampen the volatility and mitigate the risk from stocks, I mean, they still play that role. Now you have an opportunity to actually get a decent return at a much, much lower level of risk. Fixed income does have lower risk because in corporate and government settings, the bondholders take precedence over the equity holders. We're talking on the corporate side, but if there is some kind of default, that's true in governments too. If there is a default or a corporate bankruptcy, that the bondholders do get precedence, okay? So that's an important thing to know. Your risk levels are much, much lower with fixed income. Something to think about that you need to consider this side of your portfolio at the same time you're looking at the equities, and don't dismiss it because the market has changed significantly. What's worked for you in the past 10, 15 years will no longer work. The market began a terrific equity rally in March of 2009. Those days are over, folks. Low interest rates, just roaring performance of tech stocks. Not saying we might not have a little tech stock rally. We'll probably have some tradable rallies. And I am not at all suggesting that we're in some kind of permanent crash, but we might be in some kind of secular bear market that could last for several years. You need to adapt some new strategies. Hit me up if you're curious about what that would be. Hope you found that helpful today.